with AllGen Financial Advisors. Today is March 13th, 2023, and wanted to provide a quick update for everyone regarding what's been going on in the market. Over the last week and through the weekend, there was a couple bank failures, which has caused some concern. So I just want to make sure and address everyone to kind of let you know if you are at risk and what kind of AllGen is doing about it to protect our client portfolios and their investments. And we'll get into that and showing how diversification is a key piece to protecting clients' monies and how we're doing that right now based off of current market conditions. And then kind of look at with what's been going on with the Federal Reserve stepping in to secure funding and protect clients' deposits. With what they're doing with that, how does that affect a potential change in interest rates? So let's hop right in. We're first going to start off with kind of a timeline of what happened, just so that you understand kind of the conditions that were kind of started this whole thing and then how it kind of unfolded. So let's start with 2020 and 2021. When the pandemic happened in March of 2020, immediately afterwards, the stock market dropped. The Federal Reserve stepped in, lowered interest rates down to zero very quickly. So interest rates went really low. They started pumping money into the market through quantitative easing, and then even a number of stimulus packages were set up to be able to provide money directly to people and families, and even directly to businesses to keep them, operational. And during that time, kind of a transition in companies and startups and venture capital really went more to kind of virtual. It was really a good time because for that sector specifically, because there's a huge shift to more of a virtual workplace. And so a lot of startups, a lot of tech companies flush with new cash started, so basically banks like Silicon Valley Bank had huge amounts of new deposits, and those continued to increase into 2021 and started to peak out towards the end of 2021. Fast forward into 2022, the Federal Reserve, concerned about inflation, starts raising rates very quickly, and the riskiest assets started experiencing outflows because interest rates got higher. Most of these startups and venture capital firms tend to have lower credit ratings. So for them to borrow, especially with interest rates going up and in a difficult environment, it becomes very expensive for them to borrow. That causes certain defaults where they're unable to pay their loans back, and that started spiraling downward in that particular sector. Startups, venture capital, and some of those areas took a big hit into 2022. And then along that time, you also had FTX, which was the second largest exchange of cryptocurrency. And a lot of cryptocurrencies in general experienced a huge decline, which led to some corruption cases and a lot of different issues in the cryptocurrency space. So and FTX ended up filing for bankruptcy in November of 2022. So you have both startups and venture capitalists, private equity, and also cryptocurrencies all taking a hit. So the banks that actually went under, Silvergate, that actually they kind of shut down on their own voluntarily to prevent to be able to give all their clients back their deposits. But then the one that was announced last week, Silicon Valley Bank, all the deposits that they got started drying up because of what happened in the startup and the venture capital side, which is where most of their clients were. They did not have a very diversified client base. Most of their clients were made up of kind of startups, venture capital, private equity, the riskiest of clients. And so as those clients started suffering and that sector started suffering, so did that bank. Well, another mistake that Silicon Valley Bank during 2022, they didn't even have a chief risk officer for 8 months in 2022. And a lot of their deposits, instead of being able to make money in the way that they had been making money in the past by lending to a lot of the new startups and venture capital, because that dried up, and there was no longer a lot of those successful startups were no longer IPOing, going public, and that's where that bank made a lot of money. So that dried up. So they tried to make money in a different way. And the way they tried to make money was taking those deposits that the clients deposited and investing that into bonds, and some long-term bonds as well. And so as interest rates went up, we all know that when interest rates go up, bond prices go down. So that investment went down, which would have potentially been fine if they would if there wasn't a huge demand for deposits or for the withdrawals to be pulled out. So they because the base of all of their deposits started going down from these investments, that caused a problem when everyone tried to pull out money at the same time. They didn't have enough solvency to be able to provide money for all those withdrawals. And so that was what really caused Silicon Valley Bank to fail. And so on Friday, the Federal Reserve stepped in to take over the bank, and over the weekend, they also did the same thing with Signature Bank, which happened to be also have some similar issues where their client base was one of the some more risky client base, and at the same time, they made some bad investments as well with their deposits. And so the Federal Reserve stepped in and reassured everyone that not only are they, for those particular banks, are they going to be insured up to the FDIC amount of 250,000, but they're also going to cover uninsured amounts. So the FDIC stepped in a big way, and the Federal Reserve stepped in a big way to provide confidence to markets that they're going to cover the amounts that are over the 250,000 in FDIC insurance, which I'll cover FDIC insurance on another slide. So to kind of sum it all up, some of the common themes among these bank failures is that the bank's client bases, the makeup of their clients were very risky. Crypto, startups, venture capital, all of that sector is very risky. So those banks, the majority of their clients were in that area. And then very poor risk management with deposits. Not proper hedging, investing in riskier assets. That was a problem that went down. And then when people went to pull their money out, it wasn't all there. And so that was a problem. So, the real question is, should you all be concerned? Is this a risk for our clients? And a couple things to ensure you. First of all, just an understanding that the FDIC, what they do. So for the FDIC insures up to 250,000 per depositor per insured bank for each account ownership category. So different types of accounts. Like if one spouse had a $250,000 policy and another spouse has another $250,000, not a policy, deposit in that bank, then both of those would be insured. Okay. And so that's what the FDIC insures. So if a bank goes under, you're insured up to that $250,000 amount for your account. Okay. The SIPC, because a lot of our clients don't necessarily have money in a bank with us. They have money at Charles Schwab. Charles Schwab is who custodies the majority of our client accounts. So the SIPC covers brokerage firms up to 500,000. So if the brokerage firm fails and goes under, then clients' assets are insured up to 500,000. Now, Charles Schwab specifically has additional insurance on top of that. And if you're really concerned about that after this video, you can reach out to your advisor and they can provide an article or a brochure from Schwab listing all the different insurance policies and ways that they protect their clients. So specifically with Charles Schwab, and this is a little bit of a busy slide, so forgive me, but they put out a statement today just to ensure people, to give people more comfort. And in that, they kind of highlighted some major things. So first of all, big difference between Charles Schwab and the banks that failed is Schwab has a very broad and high quality customer base, client base. So across multiple lines of business, and they also have capital well in excess of regulatory requirements. So that's one thing. And then another thing is, one of the biggest determining factors if a bank is healthy, and one of the biggest causes for bank failures is a huge run on the bank, meaning a lot of people pulling out money at the same time. In February was the second strongest February ever, following January, which was the strongest January ever of new monies coming into Schwab. So monies are coming into Schwab, not being pulled out. And even in March, there's been $2 billion per trading month to date. So that includes last week, Thursday and Friday, which is when they had the big bank failures. Another big thing to point out with Schwab is that more than 80% of client cash held at Charles Schwab Bank is insured dollar for dollar by the FDIC. So just to kind of compare that to Silicon Valley Bank and the other banks that were struggling, they only have between 2 and 20% of their deposits insured, whereas bank has 80% of client cash held insured. And as a further safeguard, Schwab also has access to $80 billion in borrowing capacity with the Federal Home Loan Bank, which is an amount greater than all the uninsured deposits. So that helps as well. And investments at Schwab are held in investors' names. So each person has an account at Schwab, and it's held in their own name at the broker dealer. So those are separate and not commingled with the assets at Schwab Bank. And then finally, Schwab does not have any direct business relationship with Silicon Valley Bank or Signature Bank, so no exposure to credit risk from those areas. So that's Schwab. Now let's jump in to kind of look at what we're doing from the portfolio management standpoint to protect our clients. And we always talk about how it's important to have diversification, but not only diversification, non-correlated assets. So what this chart here looks at is that in the purple line right here is the S&P 500, and you can see kind of from March 9th of last week when the market started going down because of these bank failures, it dropped significantly. And over the last 5 days, it's down almost 5%. However, when that started happening, kind of what you would consider safe haven assets, so bonds, particular US government bonds, and even gold, all of those, which are the other colors, started going up. So that's what's typically supposed to happen, and what usually does happen when you go into a difficult situation in the market. You have your safe haven assets that typically go up, and you can see long-term treasuries were up 4%, and then you have just a regular or gold down up 3.6%, and then just the aggregate bond up 2%. So that's anywhere from almost a 7% all the way up to a 9% spread, and the difference between what happened to stocks and what happened to the safe haven assets. That's why it's very important to have non-correlated assets in things that go up when the market goes down. Our clients do hold, obviously, bonds, long-term treasury bonds, regular, kind of core aggregate bond holdings like the green line, and then like the orange line, and then they also have gold like the green line right there. So we do try our best to diversify between multiple asset classes to protect client accounts during difficult situations. And then this is very interesting. So, kind of going into before these bank failures, kind of going into last week, you had interest rates that were supposed to go up pretty high and continue to raise even higher than what we initially anticipated at the beginning of the year. And so what this chart looks at, you can see at the bottom, is the different Fed rate probabilities. And we're looking for where the market, the federal funds rate, is going to end the year at. And these are the probabilities or the futures that kind of determine the probabilities of where interest rates will end at. In some, as of a week ago, a month ago, most of the predictions where interest rates were going to be somewhere, or in the year, somewhere between 4 3/4 to 5, all the way up to 5 1/4 to 5 1/2. And now, after what happened last week, and the Federal Reserve stepped in to help out, there's some concerns about the market. Now the Federal Reserve looks like they're not going to try to raise interest rates as quickly, to be in a more of an not as a tightening kind of position. So that now it looks like they're going to end the year somewhere between 3 3/4 and 4, somewhere around that range. So that could be anywhere from a 1 to almost 1.5% difference than what markets were thinking a week ago and a month ago. So that's a big shift in interest rates. It looks like interest rates will now not go up as high, and they will start coming down at a faster rate. That could all change, certainly. But that's what it looks like right now after what's gone on over the last week, which actually could be good for bonds. Remember, when interest rates go down, bond prices go up, so that could be good for bonds. It has recently, and that could continue. It could also be good for gold. As interest rates, go down, typically the dollar gets weaker, and as the dollar gets weaker, a lot of times gold will go up. So those assets in a difficult scenario could help out. The stock market may even like that the Federal Reserve starting to lower interest rates, as borrowing won't be as expensive going forward. So that could also help the stock market. So all these things I want to point out, just as there's been a little bit of shift of what's been going on in the market. I wanted to address all the concerns that people have with what's been going on with the bank failures, and just to ensure you that everything is solid at Charles Schwab, and that they did not take on the same level of risks as these other banks did, and they are much more diversified and much more conservative, and much better capitalized than those other banks. So if you have any questions, feel free to reach out to your advisor, and we'd be happy to help. All right, take care. Have a good one.